This video covers solving capital budgeting problems. I'm your professor, Dr. Stephen Haggard. Here we have a typical capital budgeting problem. These are the kinds that you might see in homework or on an exam, but in fact they're actually far simpler than what the real world would have us to work out. If you want to see an example of a real-world capital budgeting project, please see my videos on the Baldwin Company example. But for now, what we're going to do is use this problem that I pulled from Connect. This material is copyright McGraw-Hill, and I'm using it with their permission and my gratitude. So here's the problem. Down under Boomerang Incorporated is considering a new 3-year expansion project that requires an initial fixed asset investment of $5.346 million. The fixed asset will be depreciated straight line to zero over its 3-year tax life, after which it will have a market value of $415,800. The project requires an initial investment in net working capital of $594,000. The project is estimated to generate $4,752,000 in annual sales, with costs of $1,900,800. The tax rate is 34%, and the required rate of return on the project is 12%. What is the NPV of this project? In fact, when I see a problem like this, what I usually do is go straight to the end and see what they're asking, because sometimes they give you far more information than you need to actually solve the problem. In this case, we are going to need every single bit of information that's given here. Many times, students do not even know where to start on a problem like this. So you need to ask yourself, what are we looking for? Well, they ask for NPV. How do we find NPV? Well, the NPV is just the cash flow from assets discounted at a rate appropriate to the risk. In other words, it's the sum of the present values of the cash flows from assets. So we need to find cash flows from assets. And the good thing is, once we find cash flows from assets for all the years of the project, we can also find IRR quite easily, and I'll show you how to do that. So what does cash flow from assets equal? Operating cash flow minus net capital spending minus the change in net working capital. That triangle is the Greek letter delta. In science and mathematics, we use it for change. Now, operating cash flow we can break down as EBIT, or earnings before interest and taxes, minus taxes, add back depreciation. Now, let's talk about interest in capital budgeting projects. You never include a cash flow for interest in your capital budgeting projects, because that rate that's appropriate to the risk, that's how we're accounting for the financing costs of the project. So if you include interest or dividends, then you're actually overcharging yourself for the financing costs of the project. Okay, so we need depreciation because it's used in both finding EBIT and in finding OCF once we have EBIT. So we're going to start there. But first let me say this. We add back depreciation in operating cash flow because it is a non-cash expense. We have to add it back in order to get back to a cash basis. It's missing from EBIT. That's why we have to add it back, but you'll see that in a minute, why it's missing from EBIT. Unless you are told otherwise, you should always assume that we're going to depreciate straight line to zero. Fortunately, in this case, we are told that we are depreciating straight line to zero, which always makes it simple. We're told that the project needs $5.346 million in initial fixed assets that are depreciated straight line to zero over the life of 3 years. Therefore, our annual depreciation is going to be $1.782 million. How did I get that number? I merely took the initial investment and divided it by the number of years in the life. Here it's 3, and that's how we got our annual depreciation. Now you need to be careful here, because the project also tells us that there is a market value of $415,000 and some change for this equipment at the end of the project. Sometimes students will say, aha, I should only depreciate down to that level. But you should always depreciate down to zero whenever possible. First of all, the government allows you to. And secondly, the reason that you want to is because when you over depreciate your assets, you're underpaying taxes in the early years of the project. And you want to push those taxes as far into the future as possible because due to the time value of money, those dollars will be worth less when you pay them in later years than they would have been if you'd paid them in the earlier years. So don't worry about that market value at the end of the project when we're calculating our depreciation. The next step is to determine EBIT, or earnings before interest and taxes. So anytime you want to do this, what you start out with is the money that's coming in, either through sales or cost savings. And then we're going to subtract out the associated costs and the depreciation. In this case, they tell us that the sales are $4,752,000 and the costs associated with those sales are $1,900,800. You might also think of this as cost of goods sold, but in this case the costs also have any sort of fixed costs associated too. And then the depreciation, which we calculated as $1,782,000, we're going to subtract those out and get an EBIT of $1,069,200. Now, typically to get pre-tax income, what we would do is take EBIT and subtract out the interest. But there's no interest involved here, so the EBIT is the pre-tax income. Remember, we do not include interest cash flows in capital budgeting projects. And so it's easy enough then to figure out our taxes. They're just 34%, which is the tax rate that they gave us, 34% of the EBIT, which turns out to be $363,528. Next, we're going to calculate operating cash flow. Operating cash flow is simply EBIT minus taxes plus depreciation. We have to add back that depreciation because remember it was subtracted out when we calculated EBIT, and depreciation is a non-cash expense, and what we're looking at here is operating cash flow, so we have to add it back. So we have our EBIT from the previous slide of $1,069,200. We're going to subtract the taxes we calculated earlier and add back the depreciation that we calculated earlier. And that's going to give us an operating cash flow of $2,487,672. Now we're going to calculate net capital spending. Net capital spending in year 0 is simply our initial investment of $5.346 million. The problem referred to those as fixed assets, I believe. For this problem, our net capital spending for years 1 and 2 is 0. The reason is that they haven't mentioned any other acquisition of capital goods in those years or anything that we would need to do there. Now, in the real world, you may have additional capital expenditures in those years, so you need to always be on the lookout for that. You can't just assume it will be 0. In year 3, we are going to sell the assets for $415,800. A lot of times students get confused here and think that this is net capital spending, but it's not, because there are tax implications anytime you sell an asset for something other than book value. And keep in mind that we have depreciated this asset down to 0, so the book value is 0. And so we're selling this thing for $415,800 more than book value. That means that we have underpaid our taxes because we have over-depreciated the asset, which means we're going to owe some tax back. So we have to do something called after-tax salvage value, or ATSV. And that's simply equal to the market value of the asset at the time you sell it, minus the tax rate times the difference between that market value when you sell it and the book value at the time you sell it. So the market value here is simply the $415,800, tax rate is 34%, and the book value is 0. So if we do the math out, we get $274,428. Now keep in mind, order of operations when you work something like this. You always need to do the stuff in the parentheses first, then multiply by the tax rate, then do your final little bit of math there. Now this net capital spending is actually going to be a cash flow back to us, so we'll have to make a differentiation for that on the sign when we do our calculations. The final component that we have to calculate is the change in net working capital. They tell us that we have an initial investment of net working capital of $594,000. Since this particular project had no net working capital associated with it to begin with, that means we have a change in net working capital of $594,000 in year 0. Now, sometimes you'll get problems that talk about a reduction of net working capital at the beginning. For instance, if it's a new inventory system or a new ordering system. So it's not always a positive investment in net working capital. Sometimes it's a reduction. So keep an eye out for those because the signs are opposite. Now, we are not given any information about change in net working capital in the remaining years. And so we can assume that net working capital does not change in the middle of the project. That's not always true. In fact, sometimes, most of the time, net working capital is assumed to be a percentage of this year's sales or the forecasted sales for next year. And in those cases, if sales change from year to year, then you should expect your net working capital to change year to year. And you should expect to have a change in net working capital for every year of the project. Now, we always assume, regardless of whatever else is going on, we always assume that net working capital goes to 0 in the last year of the project. Think about the things that go into net working capital. These would be inventory and accounts receivable and cash. And so what we assume is that we sell the inventory for an accounts receivable, we collect those remaining receivables, and then we just hand all that cash back to the mother ship. In other words, the corporation, once this project gets shut down. And so that means that NWC goes to 0 in the last year of the project, and so the change in net working capital, therefore, has to be minus $594,000 in year 3, because that's the only way that net working capital can get back to 0. Now we're going to start setting up the table that's going to allow us to calculate cash flow from assets. But let's talk through first what happens with these cash flows. First of all, operating cash flow occurs only in years 1 through 3, not in year 0. Remember that in finance, the time that we give, whether it be 0, 1, 2, or 3, is the end of that period. And so time 0 is the end of the 1 year preceding time 0. And any operating cash flow that happened before the factory built would be 0 because we didn't have a factory to manufacture anything. And so OCF at time 0 is 0, but it's equal in years 1 through 3. Net capital spending only occurs in this problem in years 0 and 3. 0 when we buy the assets, and 3 when we dispose of them. And the change in net working capital only occurs in years 0 and 3. Year 0 when we invest that net working capital, and year 3 when we return it back to the parent corporation. So therefore we've got 3 different cash flow regimes. Year 0 is unique, years 1 and 2 are alike, and year 3 is unique. And we're going to set up our table accordingly. So here we have our table. And as we mentioned in the previous slide, year 0 is its own column. Years 1 and 2 share a column because they're identical. And year 3 has its own column. And for each of these columns we have rows for operating cash flow, net capital spending, and change in net working capital. And we mentioned that operating cash flow in year 0 is 0, but then it's the same numbers for years 1 through 3, and our chart reflects that. Our net capital spending in year 0 is $5,346,000. Now I want you to notice that this is net capital spending. Money flowing out from you in spending is positive. Money coming back to you in spending is negative. So net capital spending looks a lot like your credit card bill. The positive numbers are money flowing away from you. The negative numbers are money flowing back. And it's the same way with net working capital, the change in net working capital. In order to build up that net working capital in the beginning, the corporation has to disperse $594,000 worth of cash. But at the end, they get that money back in year 3, but nothing happens in years 1 or 2. Now we are finally ready to calculate cash flow from assets. And I put the formula down below to help you remember. It's operating cash flow minus net capital spending minus the change in net working capital. Sometimes students get all excited, and instead of subtracting net capital spending and change in net working capital, they just add all this together. Needless to say, they get the wrong answer. And so if I take 0 minus 5,346,000 minus 594,000, I get negative $5.94 million for my cash flow from assets for year 0. Years 1 and 2 are quite easy. It's just simply equal to the OCF. And so I just bring that number down. And then in the 3rd year, I've got my operating cash flow. And then I have negative net capital spending and negative change in net working capital. Well, if I'm subtracting a negative, that's actually like adding. And so when I add all those together, I get a nice big juicy $3,356,100 for my year 3 cash flow from assets. Now we are ready for the final step, where we find net present value. We're going to use our TI-BA 2+ calculator to do this. So if you don't already have it out, pause the video and get it out now. Okay, the first thing we want to do is hit the CF button, then the second button, and the CE/C button, which is in the lower left-hand corner. That clears out all your old cash flows. And that's important to do because your calculator will remember old cash flows that you've got in there that you previously put in. So if we had more than 2 cash flows, like we're going to have here in a previous one, we would have extra cash flows waiting out there just hoping to mess up our result. And so now that we've cleared it out, the calculator should say CF0. That's your cash flow at time 0. And we're going to type in 5,940,000 and hit the plus minus key and hit enter. If you don't hit enter, it's like it never even happened. And then you want to hit your arrow down key. Now your calculator should say C01, and we're going to do 2,487,672 there. That's the cash flow for time 1 and 2. We're going to hit enter, and then we're going to hit arrow down. Now F01 here is the number of times in a row that that identical cash flow occurs. In this case, it happens twice in a row, year 1 and year 2. And so we're going to say F01 is equal to 2, then hit enter, and then arrow down. Finally, cash flow C02 is 3,356,100, and hit enter, and we're done. Now, you could go down and look at F02 and make sure it says 1, but I guarantee you that it does as long as you cleared the calculator out the way I told you to. Now I want you to hit the NPV button on your calculator, and it asks you for an interest rate. This is going to be the required rate of return for the project. In our case, it's 12, so I type 1, 2, and hit enter. Then I arrow down, and now it'll say NPV equals 0. You want to hit the compute button, which is in the upper left-hand corner, and you will learn that the net present value is $653,098.29. What does that mean? It means that this project would create $653,098.29 worth of shareholder value. So that's a real dollar number. And since the goal of financial management is to make our shareholders wealthier, this project would help us toward that goal, so we should accept it. If the NPV was negative, we would reject it because it would be destroying shareholder wealth. And finally, just for fun, since we have the numbers anyway, let's find the IRR. So hit your IRR button and then hit your compute button. And it turns out that the IRR of this project is 17.97. That's a percentage, so that's a rate of return. Now you know how to set up capital budgeting problems and solve them for your homework and for your exams.